What's up everyone? In this video, I'm going to go over a really important concept to be aware of before buying long-term options, or what a lot of people like to call leaps. So I know, I guess like the main goal of the stock market is to buy low and sell high, obviously, but it's not that simple. And especially when it comes to the options market, there's a lot of other factors that come into place besides buying low and selling high. For example, like Tesla exploded up this week, but I'm sure a lot of people still lost on playing weekly Tesla call options because of implied volatility or theta decay or a bunch of other external factors. And in the same way that short-term options decay at a rapid pace because of options theta, long-term options are really affected by implied volatility. So in the options market, there are like four main Greeks. We have delta, theta, gamma, and vega. And basically, these Greeks treat different expirations differently. So for example, if we go to, let's say we went to Zoom. If we go to the options chain and we went to like the January 2024 expiration, we can see that the 200 strike call for this has a vega value of 1.05. So just keep that in mind. And then if we go to like the December 31st of 2021 expiration, the 200 strike call only has a vega value of 0.09. So the main point to understand here is that Greeks affect different strike prices and expirations differently. Most people know that theta decay or time decay is really brutal on short-term expirations. But what not a lot of people know about is how important vega is on longer-term options. So if we look in the market right now, there are so many opportunities. Like there's opportunities everywhere, especially for like buying the dip, maybe some long-term calls, share positions, short put positions, and a bunch of things like that. But just because a stock is low and it's at a good level for the long term, that does not mean just to buy leaps or long-term call options, because you're going to find out right now why that could be a bad idea. So if you have a stock that you really like right now, a lot of people just think, all right, I'm going to buy a long-term call option because over the past 2 years, the market has just been exploding and basically any long-term call options have done very well. But you just have to be careful doing that. So let's look at two different setups right now. The first one will be Teledoc. Let's say you like this stock for the long term at this level, and we look at like a max weekly chart. We can see that over like the past couple of years, this stock went from $9 up to $308, and now it's at $95. So it's like kind of like bottoming off, or we think it is at least, and you want to buy in. The problem with this is the implied volatility. So if we look down a little bit, we have to remember that implied volatility basically represents how expensive the option is, or the options are on this stock. For example, when implied volatility is high, that means options are expensive. When implied volatility is low, it means options are cheap. For Teledoc right now, it's kind of like in the middle of this range. Like it's not really cheap, but it's not really expensive either. But this is a pretty big problem, especially for long-term positions, because when you're buying long-term call options, you want that implied volatility to be pretty low, and that's not what we're seeing right now. So looking at Teledoc, we can see the implied volatility is like 67%. If we go to the options chain and we go all the way out to January of 2024, the 100 strike call right now has a vega value of $51. Basically what this means is for every 1% implied volatility goes up, the options, or specifically the 100 strike call, goes up by $50. Okay? To put that into perspective, just a couple weeks ago, the implied volatility on Teledoc was at like 47%. Now it's at 67%. So to say the least, these options have gone up quite a bit just because implied volatility rose. So what that means is, let's say you were to buy like a Teledoc call right now, knowing that implied volatility is, I guess you could say mid-range, it's definitely not low. If this stock were to rise and implied volatility were to fall, you would easily easily lose money on this position. So the main thing to understand here is just because stocks are low, that does not mean you want to go and buy long-term call options, because if implied volatility is mid-ranged or high, you are going to get screwed over big time, because when that implied volatility falls, your options are just going to get destroyed. Now here's the thing. If the stock really, really explodes up, then you might get away with a profit, but the risk reward just doesn't pay off. So in a situation like this, instead of buying leap call options, what you can do instead is shares. That's never a bad idea. You can do like a call debit spread, where that is basically like if you were to buy the 100 strike call and then maybe like short the 130 strike call. It's like a pretty similar stance. You can say you're still using options and your theta will actually be reduced. So that's something to keep in mind. Or what you could do is, like, let's say you were buying the leap option, the 100 strike call for January, because you wanted to leverage your position and you wanted to leverage your money. I don't recommend this, but if you wanted to, instead of buying an overpriced call option, what you can do instead is, like, instead of putting 2,800 into another overpriced call, you can just take that 2,800, put it into a normal brokerage account, or a margin account, I should say, and then you can use margin and then buy the shares like that. You'll still get that leverage, but at least you're doing it in a way that's a lot easier to make money. For example, if you were to put 2,800 into the 100 strike call, your break even's not until like $128. Instead, you could use that same money, leverage it with margin, and then your break even's at the current price of like 95. So I would really consider just exploring other options besides just buying leaps when the stock's low, because there's a lot of other factors that come into play. Now, let's say you have a stock that's actually, like, it's at a good level, you like it for the long term, and the implied volatility is low. An example of this would be with Corsair. Then it's okay to buy leaps, because if we go out to, let's say we go out to January 2024, we can see that the Vega on these $22.50 calls is only $12. So it's like, the Vega is not as much, and then another thing is like the implied volatility is still really low already. So it's not like it's gonna fall off a cliff. So long story short, when you see stocks at low levels, do not just default to buying leaps. There are other smarter things that you can do that will be more profitable and less risky for your account. The biggest thing is using implied volatility to your advantage, and understanding that the same way that theta affects short-term options, we have Vega affecting long-term options, but in a bad way. So please keep that in mind. I hope you learned something from this video. I know there was a lot of information to go with it, but if you have any questions, just leave them in the comments down below. I'll definitely answer them. So yeah, I know it was a little bit confusing, but if you have any questions, just let me know in the comments down below. Besides that, thank you guys so much for watching, and Merry Christmas.